having a bank account is almost a must for any corporation or business. So we're going to talk today about bank accounts and them as a form of internal control. What happens with a bank account and why it's such a great internal control is because it allows you to put all of your cash at their location and not to keep it on hand. A bank statement that is provided to you by the bank will also give you accurate information about how much you have, how much you've spent, how much you get. And it also allows your customers to pay you through electronic funds transfer. So we basically talk about a bank statement. Most of you have a bank account, but I can guarantee you nobody gets a bank statement in the mail today. It's almost all done electronically. And you might say, well, I don't really ever need to look at it because I look at it every day online. But you have to understand that a business pays out more money, pays out more checks, receives more money than you do as an individual. So having a bank statement and actually looking at it and analyzing it every month is a must when you are a business. So here's an example of a bank statement. It'll always tell you what period it's for. It'll tell you the beginning balance. It'll tell you all the deposit totals, how many I have and the total of them up here. It'll tell me all of my withdrawals. Now this could be a check that was written that somebody cashed. It could be you paying somebody electronic funds transfer. Any money taken out of the account or any money added to the account. Those are deposits and withdrawals. Then we'll talk about other debits and credits. And here, debits and credits have a little different meaning than what we talk about in our journal entries. And then it's going to show the ending balance for the period. So here's an example of a bank statement. These are all check numbers with the amounts actually taken out. These are deposits over here. And sometimes there's some miscellaneous things down here that are happening. And so there's a whole bunch of things down here that might be happening. You might have a bank service charge. You might have a non-sufficient funds check. That's when your customers wrote you a check and there's not enough money in their bank to cover it. You have to remember that the bank's records, from a company's perspective, the bank's record is a liability. It's like accounts payable. So a credit balance is when it's increased. So when you're putting money in the bank, it's a credit. When you take money out the bank, it's a debit. So from a business perspective, from the bank's perspective, your money in there is that liability. I'm sorry, I said that wrong. From the bank's point of view, them holding your money is like an accounts payable. They owe you money. A credit increases. So here's what I want you to write down right now. I'll wait till you get a pen and paper. A credit memo is when you're adding money to your account. So if you get a credit memo from the bank, they added to the account. But if they send you a debit memo, they took away from the account. So credit memo adds, excuse me, a debit memo takes away. And here's why you might be adding to your actual account. Okay, so you might be adding because one of your customers paid you through electronic funds transfer. Your bank might have collected a note that somebody owed you money and put it in your account. You might have earned interest on the money in the bank, or there could be a bank error. So we're going to examine the bank statement. And here's, when we look at the bank statement, here's the things that would be debit memos. This is money being taken away from your account. Any payments you've paid to suppliers through electronic funds transfer, if the bank charges you a service charge. Now, in today's real world, as a personal account, most banks do not charge a service charge, but they actually do for businesses because they know they run, first of all, they have more money and they run lots more money through checks and deposits. Another way a bank might take money from you and issue a debit memo is one of your customer wrote you a check and it got returned for NSF, which is non-sufficient funds. And again, any bank errors. So here's a little diagram. Here's a little diagram showing your company, and this is your money, this is your cash ledger. ledger. So remember, a cash account is increased as a debit, decreases as a credit, but on the bank side, it's a liability. So these are some of the things you're going to find on a bank statement. We've already talked about them. NSF, SC, these are acronyms, miscellaneous type items. Things do actually happen. So we're going to take the bank statement and compare it to what our cash ledger account says, and that'll actually become our bank reconciliation. When we actually take a look at our bank statement and compare it to our cash ledger accounts, we're going to find there's going to be differences. And a lot of times it's just about when transactions were recorded, or the bank's done something that we didn't know about, or sometimes there's actually even an error. So these are the different things we're going to talk about. So here's an example. So we're going to be looking at the bank statement beginning balance, which is the end of that month. We're going to look at anything that's going to be added. Then we're going to look, and we're going to add it. Then we're going to look at things that was subtracted, and then we're going to subtract, and we're going to come up with an ending balance. Then we're going to compare it to our actual, actually, I'm sorry, that's not what's showing on this slide. I made a mistake. This is the bank statement. So this would be whatever the beginning bank was, plus all my deposits, minus all my checks or anything subtracted. So here's the ending balance on my bank statement for the end of the month. But my cash ledger says I have this. And so what we're going to actually do, so this is my cash ledger. This is what the bank says. So we're going to actually do a bank reconciliation to prove the differences between these two numbers. It's called a bank reconciliation. It's very easy. If you ever did see a statement, on the back of your statement, there would be a very similar form to do, and we're going to work that out. And that's what the majority of this chapter is going to be about. So there's two different sections on a bank reconciliation form, and you can find these under my Excel templates. So the top part is called the bank side. That has to do with the bank statement side. And the bottom half is going to be the company or the business side. And what we're going to look at is we're going to have to make sure the adjusted balances on both sides end up equaling, like this. So the top half is going to be for the bank side. The bottom half is going to be for the business side. So remember, this is just like your ledger account down here. So what we're going to do, just going to go over these steps, is we're always going to start right here with whatever's the bank statement balance for the end of the month says I have, and I would put it right here. Then I would be adding things. One of the things we're going to add is called a deposit in transit, and I'll explain this shortly. Okay, because this is basically a deposit that I send to the bank, but it's not on the bank side yet. Then we're going to subtract outstanding checks. These are checks that the bank hasn't cashed, or I wrote let's say I wrote a supplier a check and they haven't cashed it yet. It would be considered outstanding. So everything I'm going to start with is the ending balance per the bank statement, add anything, subtract anything, and then I'm going to come up with an adjusted balance. So I'm also going to do the same thing with my company books down here. This is my cash ledger. What is the balance at the end of the month? Anything that's been added by the bank that I didn't know about, anything that's been subtracted by the bank and any errors, and I'm going to come up with an adjusted balance, and then they should equal. So on the next two slides, you're going to see step-by-step instructions, but I'm going to kind of just breeze over that quickly and go straight to the actual instructions. So here is the bank side. You always start at the bank side, which is the top, and the different steps you do. The ending balance of the statement, add, subtract, come up with an adjusted balance. This is for the book side, which is at the bottom. Put in the balance on the ledger the day you're doing the bank reconciliation. Add anything that the bank says they added, subtract anything they took from you, come up with the adjusted balance. So here we go. We're going to start with this. And so actually, this would be a good place. You could pause this video and actually download the bank reconciliation ledger if you'd like and take a look at it, or print it out. I'll wait while you can pause and get your form out so you can actually fill it out as we go. Just hit pause on the video. Okay, now that we're back, the bank statement shows a balance of this much money as of the end of July, and our cash balance in our ledger account says this. So this is what the bank statement says. This is what ours says. So then we're going to have other information along the way. Now, I'm not going to show you the bank rec yet, but I want to show the next thing is we've got deposits in transit, $816 and $20. So here's what happens. On the day of the bank statement, July 31st, I got my deposits ready. I put them into my cash ledger account. I sent Maria down to the bank on her way home from work. But when she got there, she was late. The bank was closed, and she put the deposit in the night depository drop, just like the library drop. So bottom line is on July 31st, I thought I had a deposit in there, but the bank's not going to get it till the next morning. So any deposits not recorded on bank statements are called deposits in transit. Okay. Now, step 3. These are the checks I'd written that had not cleared the account. And I wrote them and subtracted them from my ledger already. And the reason I know they haven't cleared the account is because I checked the bank statement and they were not on there. So there's another note. So there's 3, 4, 5. Okay, step 6. A note receivable of $400 plus interest of $8 collected by my bank. So my bank went to my customer's bank and collected a total of $408. Of that, $8 is interest I've earned, and $400 is notes receivable. Don't worry, I will explain notes receivable in the next chapter. Now, the next step is my customer wrote a check for $300 to me, but his bank didn't have any money when it got sent to his bank. So a check from my customer is returned because of NSF. Anytime you have an NSF, it is a check from your customer, and if a check from your customer will always refer to accounts receivable. Remember that. NSF check is accounts receivable. Oh, and by the way, there was now this had nothing to do with the NSF check, but the bank charged me $18 because they did a debit memo. Remember, debit memos mean taking away from my account. Up here, the credit memo of 408 was added to my account. So remember, credit memo adds, debit memo takes away. Now, the last thing that happened is going to be the hardest part of this chapter. I wrote check 879. So remember, if I'm writing a check, why am I writing checks? I only write checks for 2 purposes in this chapter. One of them we're not talking about. And that one we're not talking about is payroll. So why would I write a check? Who am I writing a check to? Correct, accounts payable. I'm writing a check to somebody I owe money to. So remember, when I write a check, it's for accounts payable. What happened is this, and this is very difficult to understand. I wrote the check for $732.26. When I subtracted it from my ledger account, I made a mistake and I transposed the numbers. I only subtracted $723.26. So we're going to have to figure out how to fix it. Now let me explain. The first thing you want to look at is the difference between the 2 numbers. And if you look at it, you'll find a difference of $9. Now the question is, how do I fix it? Oh, no, but before that question is, who made the mistake? I made the mistake when I put it in my company books. So it's going to go on the bottom half of your bank reconciliation form. If the bank made the mistake, then it would go on the top half. So that's question number 1, who made the mistake? Question number 2 is, how do I fix it? Now, let me read the whole thing again to you, and hopefully you will immediately understand how to fix it. Now, we know the difference is $9. So here's what really happened in my own words. I was supposed to subtract $732 and change, but I only subtracted